Welcome, everybody, to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Greg Werlinich, president of Werlinich Asset Management, who ended last year with approximately 100 million in assets under management. Greg, thank you very much for coming on the show.
Thank you, Adam. Glad to be here.
So, Greg, can you please tell us your story and how you got involved in the business?
Yeah, it's kind of interesting. I got in the business because of my grandfather. My grandfather was a Depression child, and he graduated college in 1930. And he always had an interest in the stock market. And he used to tell me the story that when he was 15 years old, he went to one of his cousins and he borrowed $2.50, and his cousin put up $2.50, and together with the $5, they were able to open up a brokerage account together.
Nice.
And that really began his fascination and love with the stock market. And it just kind of grew from there. And throughout his life, that was really, along with golf, was his number one passion. And even though he never made a living professionally in the stock market, that was always his primary vocation outside of his career. And he, was always an investor, both in the public equity as well as a little bit of kind of very early stage angel investing. And he would invest his own money, and then eventually it grew, and he would start to invest some family money, and then that grew, and it became friends and family money. And when I graduated college, I got a job. And then if you remember, around 1990, there was a little financial crisis, and all the banks started laying off people. And at the time, I was working for Citibank.
Right, the
and I got laid off.
Right.
And I went to work for him because at that point, I really wanted to kind of learn the family vocation because I thought investing was kind of interesting. And so he put me on salary, and I just kind of, for the next, that was 2002. So, 1992. So for the next 15 years, I worked alongside of him, just learning the trade, learning how he invested, learning the way in which he made money. Went back to business school, got an MBA, and then in Christmas time of 1996, I walked into his office and I said, "Gramps, there's not a lot of money to be made managing friends and family money for free." And I said, at some point when you're no longer able to do this, either we're going to have to hire somebody to manage money for our family, or I'll do it. And so he said, "Give it a shot." So in March of 1997, I put out a shingle. I registered as an investment advisor with the SEC, and just kind of started from zero. I'd never sold a product in my life. I've never been a stockbroker. I've always been a fiduciary registered investment advisor. And from zero in 97 until, as you said, December 31st of last year, I went from zero to about 105 million under management.
Wow, what a great story.
Yeah.
So tell us, if you can, a little about your investment strategy, Greg. How do you play the game?
Yeah, obviously you've heard of the KISS method.
Yes.
Keep it simple, stupid.
I always joke around, Greg. Sorry, Greg. I always joke around. The last S is for me, so I'm a big fan already.
Well, that is probably the most important thing that I do as an investment advisor, both for my clients as well as with my own money and my own family's money, is keep it simple.
Right.
Because the more complicated you get, the more trouble you can get in. And I always said that I want to invest my clients' money in a way that I can explain it to them in 2 sentences or less, exactly why I bought something or why I sold something.
Mm-hmm.
If it takes me more than 2 sentences to explain it, it's probably too complicated, and therefore I'm not interested.
Right.
It's similar in a way to kind of the Warren Buffett, buy and hold, hold forever. Now, obviously, nobody holds forever, but when I buy something, I go in with the idea that I'm going to hold it for at least 3 to 5 years. If I'm not interested in holding it for at least 3 to 5 years, I'm probably not going to buy it.
Got it.
I'm not a trader. I don't invest in options. I don't invest on margin for my clients. I don't short. I don't use leverage. It really is, keep it simple. buy good quality investments and hold for the longest period possible.
So let me ask you a question, Greg, because we have a lot of fundamental investors on the show. How do you determine value? Because I know value, like beauty, it's very subjective. If you can give us some or shed some light on it, we greatly appreciate it.
Sure. Well, let me preface by saying that I am not a quantitative analyst. I don't do, very deep investigative research. I'm really more of a top-down than a bottom-up, meaning what I try to do, and this really does inform the principal basis of my investing strategy. I call it a sector rotation strategy. So what I try to do is using all the kind of the broad picture research, which is all the basic magazines and newspapers and research I can get my hands on. I try to form an overarching belief of certain areas of the market that will do well and certain areas of the market that won't do well. And then I will fundamentally overweight those areas of the market that I believe are more likely to outperform the broader market for a longer period of time. And I heavily invest in the highest quality investments in those sectors. And then I avoid the areas of the market that I don't believe are going to do well. I avoid that completely. And then I'll kind of dabble here and there in one-off ideas to kind of round out the portfolio.
Okay.
I find that, and I've kind of, I've changed the philosophy a little bit in the sense that, well, I've always adhered to the sector rotation concept. Excuse me. I have gone from a very, very diverse portfolio, meaning I'd say 3 years ago, I probably had 120 stock names and another 2 or 3 dozen mutual funds or exchange traded funds in my portfolio. I probably ended the year this past year with closer to 60, 65 names of stocks and maybe 1.5 to 2 dozen exchange traded portfolios. And so I've really kind of narrowed the focus to the best ideas within the sectors rather than being really broadly diversified. So I eliminated a lot of smaller positions, a lot of things that just kind of didn't make sense to me any longer, as well as just some broad sectors that I just no longer wanted to own. And after owning some for very, very, very long periods of time, dating back to early years of my grandfather, I ended up liquidating those areas, which was not an easy thing to do, but I felt it was the right decision.
So if I understand you properly, you start with a top-down view of the world, a macro view, and say, okay, what areas are going to work, what areas are not going to work, and then you want to allocate to obviously the areas that are working. And then the question becomes fundamentally, timing becomes an issue. If you're not looking to sell and the stock goes down, do you buy more, or how do you handle the timing component? Do you use technicals at all, or how does that enter into the analysis?
Yeah, it's a good question. In some cases, I will fundamentally hold forever. Like, for example, and I won't list the individual stocks, but I happen to like the defense sector.
Right.
And so I've owned a number of different names, whether they be individual stocks, exchange traded funds, mutual funds over the years, and I've essentially never sold.
Okay.
So I've had some of these positions for 10, 15, 20, 30 years. And because I have a kind of a fundamental belief that even if they might go down 20, 25% in any one year because of some macro world event,
right,
I believe that sector will always come back. And fortunately for me, it always has. And so I've never sold that.
Okay.
Whereas other sectors that I might not have quite as strong a belief in a forever hold, it might be a shorter view. Those, if it goes against me, maybe it's a stop limit, a mental stop limit that I've set, or if something actually fundamental has changed about that sector. For example, I've been in and out of gold over the years.
Right.
I took a fundamental macro view that gold was going to do well, and so in 2004, maybe 3, 4, 5, somewhere in there, And gold was trading at that point about $350 an ounce.
Right.
And so I started buying gold. And again, it was some individual gold stocks, some mutual funds. I don't think there were exchange traded funds at that time. Or if they were very broad. And so I started accumulating a large position in gold, well, large for me.
Mm-hmm.
And over time, the price went from $350 an ounce to, I don't know, $1,300, $1,400, $1,500 an ounce. And so that whole position did enormously well, and my clients did incredibly well and benefited from it.
Right.
On the flip side, eventually the price of gold started to drop, and I didn't get out fast enough. And so for a couple of years, that whole position did very poorly for me until I ultimately sold the entire position and have not yet gone back in. And so it's, that's an example of a position where I should have gotten out a little sooner, but sector up, sector down, moved in, moved out.
Got it. So if the sector analysis is bad, but a stock shows up and meets your fundamental criteria, would you buy it, or does the sector override any individual stock criteria?
I would say generally the sector overrides the individual criteria.
Okay.
So for example, I've never owned an auto stock. I've never owned an airline stock. I, with very few exceptions, have not owned retail stocks, with Costco being one of the exceptions. So that would be the exception to the rule. So I don't like retail at all, but I like Costco a lot.
Right.
And I've owned that one for a few years. But generally speaking, I find retail too, I don't know, it doesn't lend itself to the 3 to 5 or longer horizon. It moves too quickly.
Got it. No, it makes perfect sense. So the next question, I guess, Greg, is how do you handle risk, and what mistakes do you see people make with respect to risk management? You mentioned stops before. Do you put stops in on all your positions when you enter? In other words, if it falls X%, I'll sell? Or do you, if you can elaborate a little bit on that, we'd appreciate it.
Well, I'll take that in two parts. So my own, the way I handle risk is, and I'm going to preface it by saying, some people might say that I'm very risky in the sense that I am 100% equity shop. There have been a few instances in my 22, 23 years that I've owned bonds, but by and large, I don't own bonds because they're not my thing. I don't claim to be an expert in them. And certainly for the past, 5, 6, 7 years, you really can't make any money in bonds. And certainly today, you can't make any money in bonds at all. So I've always used the example, what would you rather do? Would you rather own Verizon for 10 years, earning a 4 or 5% coupon with the dividend, with the ability to have capital gains? Or would you rather have a 10-year treasury and be locked in at 1 or 2 or 3% with no capital gains?
Right.
So for me, it's an easy answer. I'd rather have Verizon.
It's a no-brainer, yeah.
And so I'm risky in the sense that my eggs, if you will, are all in the equity basket. But within that equity world, I tend to be fairly broadly diversified across many different areas of the market.
Right.
So I spread the risks around.
Got it.
And I also kind of maintain broadly a 1 in 10. So I rarely ever let any position get below 1% of a portfolio, and I almost never let any position become greater than 10% of a portfolio.
Okay.
So when I'm building portfolios for people, I tend to build in that kind of 3, 4, 5% range. So it allows room for the stock to fall and not become irrelevant, and the stock to grow and not become too large.
Got it.
So that's how I spread risk around.
That makes sense.
In terms of mistakes, now you're talking about my mistakes, or you're talking about mistakes for individual investors that aren't with professional advisors?
Well, it's a good segue. So what are some just timeless mistakes you see people make and how to avoid? I mean, your mistakes, my mistakes, everyone's mistakes, however you want to answer it. The more mistakes you list and solutions, the better.
Yeah. Well, I think probably the greatest mistake that the average person would make is to buy at the wrong time and sell at the wrong time. The old adage, buy low, sell high, right? Well, that's, that sounds really easy. But I think most or too many average investors do exactly the opposite. They buy high and sell low because most people follow the hot money. They follow what's on CNBC or what they read in the newspaper or what their Uncle Ralph tells them or what the cab driver tells them.
Right.
But the problem is by the time Uncle Ralph and the cab driver know about it, it's probably already near or at a high.
Right.
And so they're getting in then, and then inevitably it tends to fall. And then they're saying, okay, well, it was 80, now it's 70, I can't sell. Now it's 60, I certainly can't sell. Now it's 40, oh my God, I've lost 50% of my money, I got to get it back. And by the time they sell, it's down to 20, and it's the point of maximum pain.
Right.
So they sell at the point of maximum pain, and that is usually around the point at which it starts to go back up again.
Right.
And so that is, and believe me, I've made that same mistake myself. I mean, in 23 years, I've made it more than once.
So have I.
And it is psychologically probably the most difficult thing to avoid is avoid selling at the point of maximum pain.
So I have to jump in for a second here, Greg, because one of my core tenets is something I created. It's called the 1 second rule. And it doesn't just apply to trading, even though I learned it from trading, but it applies to just about everything in life. And it's a simple phenomenon. How many times are you doing something and then you're about to give up, or like your words, max pain? And had you continued for one more proverbial second, it would have hit. You would have found it, whatever it is, right? So you're at the traffic light, you're waiting, so bored, you put the car in park, and then boom, the light turns green. Just a silly example. You're in the stock, you can't take it anymore, you sell, boom, it goes up without you. So that, I mean, I've seen that thing manifest itself in so many ways, so many times every day. It's such a good point. So how do you avoid making that mistake?
Well, the best way I can put it is just being as patient as you can possibly be and sticking to your plan.
Okay.
So whoever you are, whether you're a professional, whether you're a day trader, which hopefully most of your listeners are not, or if you're just a guy sitting at home or a woman sitting at home investing their own money, the most important thing is to have a plan. So what is the kind of the average rate of return that they would like to achieve on their money for the amount of risk they're willing to take on in order to achieve that rate of return? How far in the future are they investing for, and when do they want the money? So if you're 25 or 30 years old, you should have kind of roughly an infinite horizon, and you shouldn't really worry about the vagaries of the market, even what happened this past March. You shouldn't care. In fact, if you're 25 years old, it's a good thing because now you can buy at really good prices.
Right.
If you're 40, you still kind of shouldn't care because you still have an opportunity to invest for another 20, 25, 30 plus years. If you're 60, you care. And maybe you need to be altering your investment strategy to match your shorter time horizon. And so, everybody needs to be thinking about what's their time horizon, what is the amount of risk that they're willing to undertake in order to achieve the returns that they either want or need to achieve their financial goals. Right. And so having a plan, sticking with that plan, being patient, but also being flexible enough to make changes as conditions dictate.
So what would be an example of that? The stock price moving against you or moving in your favor, or the environment changing like what happened with COVID in early 2020?
Yeah. Well, I think I'll give you some broad examples. So as the world of COVID has now enveloped us, we as investors have to look and say, okay, well, what does the next couple of years look like? Is it a world in which leisure and entertainment might be inalterably changed, or at least inalterably for the next few years? Now, if you believe that, then you might not want to invest in the leisure and entertainment industry, whether that be cruise ships, airplanes, movie theaters, sports teams, live entertainment, theme parks, anywhere where people are going to have to congregate in mass in order to enjoy whatever that thing may be. And so if you believe in this kind of new world thing, then you would probably want to completely avoid all of those sectors. Might include restaurants, the publicly traded restaurants. On the other hand, you might want to invest in pharmaceutical stocks. You might want to invest in biotechnology stocks. You might want to invest in the kind of the social media or social distancing technology stocks, which are now all the rage. Now, one might say that they've moved too quickly, too fast, and you might want to wait. But again, as a general trend and as a sector, that'd be a good place to look.
No, that makes sense. So I guess just to recap, the mistakes people make is that getting out at the maximum pain point and not having a plan. So they're just kind of flying by the seat of their pants type of a thing. And then when the market changes, they just react emotionally to the market and without a plan. Is that kind of what you're saying?
Well, we've all heard the stories that every time there's a crisis, whether it was the tech bubble in 2000, 01 and 02, or there was the financial crisis and all the smaller drops that have happened in the ensuing 20 years, oftentimes when people sell at that point of maximum pain, the turn is not so far ahead of that. So the turn happens, but they're out of the market.
Right.
And as the turn happens, that is usually the point of the greatest return in the market on a percentage basis. So they miss it. So they've missed that huge percentage increase. And then they say, oh, well, I need to wait because it'll go back down. Well, then the market keeps going up. And they say, oh, my God, I'm still out of the market, but it's going to go down. And then it goes up further. And now they've reached the other side of the point of maximum pain because they're not participating in all the gains. So this is when those people start to go back in. They've missed all the big gains. They get in near the top, and invariably, that's the point at which the market turns over and rolls back down again.
Right.
And so it's this never-ending buy high, sell low, because there is no plan. They're just kind of following the herd. They're following the news and following what Ralph and the taxi driver are telling them.
Right.
Rather than saying, I have a fundamental idea of what it is that I'm trying to accomplish. On X age, I'm starting with Y dollars, and I need to get to Z dollars in B years. And it's just, you just have to kind of do the math. If you're at 40 and you want to get to 70 and you have 100,000 and you want to get to 1 million, you just have to get a certain return average every year for 30 years to get from 100 to 1 million.
Right.
How do I need to invest in order to get that average annualized return? And then just stick with the plan.
Oh, that makes perfect sense. So what are some some other timeless lessons that you've learned along the way that you'd like to share with the audience?
Other than buy low, sell high, not the other way around.
Right.
I think, to the very best you can, think long term. Don't think short term. Thinking short term is probably the worst mistake any investor can make, unless you're a professional trader and you've got, crazy quants working for you and crazy computers doing the math and high-speed wires. But that's only the 0.001% of the investors. For the people that are listening to your show, you want to be a long-term investor. Buy quality names, whether they be quality mutual funds. And if you're going to buy mutual funds, make sure they're low-cost funds. And you're probably better off with, funds like a Vanguard. And by the way, this is not a commercial because I don't own Vanguard funds, but they're known for being very low cost. Or buy good ETFs that trade broadly with lots of volume. Don't buy the little ones that are very thinly traded because you can get in trouble. You can't get out of them when you want to. Or buy just good quality stocks, preferably ones that pay a dividend or have the ability to pay a dividend. Like Google does not pay a dividend, but it has the ability to do so, and sooner or later, bound to do it.
Right.
Apple finally started paying, Microsoft finally started paying, et cetera. So buy, good quality names, hold them for as long as the reason for why you bought them continues to make sense. Don't worry about the macro things in the world that affect the market as a whole. Only worry about the reasons why either the sector that you're playing in or the individual company's story no longer makes sense. that's when you have to sell. If the story no longer makes sense, not if the market falls. The market doesn't affect the story.
So let's pause there for a second. Well, I guess the question, Greg, is how do you separate the story from the stock?
Mm-hmm.
In other words, how do you know when it's time to sell, the story no longer makes sense?
Well, let's see, what would be an example? Okay, I used to own a bunch of bank stocks back in the day.
Mm-hmm.
And leading into the financial crisis, I started to sell them. And I ended up selling all my bank stocks except one. I continue to hold one of them. And the reason I held that was because it was a very long held position with very low cost. And it was what I considered to be the best of breed. And I knew it wasn't going to go out of business, because if that one went out of business, we were all in trouble.
Right.
But the other ones, the story changed. Fundamentally, the story changed for the entire financial sector of the world.
No, wait.
And so that was a precipitating reason why one would sell if you owned bank stocks, insurance stocks, all of the things that were related to the financial crisis.
No, that makes sense.
And going into COVID, I think, again, as I mentioned before, if you're into that, in the kind of the entertainment, recreation part of the market, that fundamentally changed. Look at Warren Buffett. He sold all his airline stocks and he took losses of billions and billions of dollars. And he's a guy who holds forever. But
right.
He didn't. In fact, he's been in and out of airlines twice and lost both times, because airlines are a terrible business.
Right.
Terrible. Which is not to say you can't make money, because now they are basically oligopolies.
Right.
But you have to be willing to get in and out. And I don't like doing that personally. But if you're nimble enough and you can get in and out, you can make a little bit of money, but it's not a long-term, fundamentally sound business. Same with the auto stocks. Just not a fundamentally sound business.
So when the story changes...
Those are examples where the story changed.
Understood. Now, what about when it changes for the better? Do you have examples where you're like, hey, you do sector analysis first, where something's left for dead for a long time, and then the story changes for the better?
Yeah. Tech is a perfect example. Going into 2000, I had a lot of tech. I had so many of those .com stocks, and I had made lots and lots of money, and I thought, man, am I smart? My God, this is easy. This is great. Everything goes up every day.
Right.
And then the bubble burst, and I, as well as everybody else who owned anything related to technology, just got crushed.
Right. Now,
the good news for me is that as a percentage of my overall portfolio, technology was still a relatively small piece. So while everyone else lost, 50% of their money or more over those 3 years, I think, and I'm making the number up, I lost, 35% of my money or 30% of my money, whatever it was.
Right.
I still lost, but I lost less.
Right.
I didn't buy a tech stock after that for probably more than a decade.
Oh, wow.
Not one single solitary tech stock, because it scarred me.
Right.
And it took me a long time to get back in, but I did. And I started buying tech stocks again, I would say 2012 or 10, 11, and 12. So in there, kind of right as the financial crisis, as we were coming out of it,
right,
everything was dirt cheap. And
right.
So I started buying, and I bought some great quality names, and some of them I still have today, more than a decade later. And on some of those, I've made many, many multiples of my money. And again, it's, buying good quality names for hopefully at a relatively low price, and being willing to hold them throughout the vagaries, because even since then, we've had a couple ups and downs, and I've never sold them. And during the downs, sometimes I've added to some of those positions. And now, out of my top 20 holdings, I would say, I think 8 of them are tech stocks.
Nice.
Whereas it was 0, 10 years ago.
No, that makes perfect sense. It's a great example. So, Greg, how do you, I guess position sizing would be one, you briefly spoke about that earlier, but how do you
if you can
speak a little about position sizing and then portfolio management also, How many stocks do you have in the portfolio, so on and so forth? You shed some light on those topics, if you don't mind.
Well, as of the end of April, I was down to 48 stocks and 6 exchange-traded funds. I made a mistake. During the worst of the COVID thing, I set hard stop losses on all my ETF positions. And I got knocked out of every single solitary one of them, but my 3 healthcare-related ones, because those never fell enough to hit the stops.
Right.
I've subsequently bought back 3 of the positions that I sold, but I still haven't bought back some of the others because they went up so fast that I didn't have an opportunity to buy them back.
Right.
And that was the mistake of mine, because I kind of sold at the point of maximum pain because they hit a stop loss. And I was trying to be disciplined so that I wouldn't allow those clients to have extraordinarily large losses. So it hit a percentage and I was out, regardless of what I thought of the reason for being in the first place.
Right.
And that was, sometimes you have to do that when it's clients' money. You just can't take the risk.
Yes.
But if it was my own money, I wouldn't have sold them. I would have been willing to hang on through that. But for clients, that's the difference between managing your own money and managing client money.
100%. So
that was one example. And I mentioned before the 10% rule. So I try not to allow any position to get above 10% of a client's portfolio. And usually, I'll sell little bits and pieces so that I keep it under 10%, and I'll take those profits and I'll turn it around and reinvest it either into a new position or into one of the positions maybe that isn't doing so well, has fallen into maybe a 2%, and I'll bring it back into that 3 or 4% range. And so that way it's kind of it forces rebalancing, if you will.
Understood. So when you initiate a position, let's say you have, $100 and or let's say $1 million, whatever it is, and you want to buy a position, do you buy a 10% position or 18%, or do you buy a 4% position? 2%? I mean, I'm just trying to understand the process initially. And then do you average up or average down? Do you add to it, or does it just grow by appreciation?
So that was a lot of questions. I'll try and answer them all.
Sure.
If you came to me and you say, Greg, here's $100,000, I'm 40 years old, and this is money that I don't need to touch for the next 30 years, just and we do a risk tolerance profile, and I get all the information from you, and you say, okay, Greg, go at it.
Yep.
Let's assume, for the sake of this discussion, that market conditions allow me to spend all the $100,000 at once, which normally I wouldn't. It might take me months to spend it, but for the purpose of this conversation, I would probably buy something like 20 positions to give me a 5% stake.
Got it.
In each.
Got
so, it. Some might be 4, some might be 6, depending upon how I like something.
Right.
Maybe it's 3%. So somewhere in that 20 to 25%, 20 to 25 number of positions to get to the $100,000.
Right.
So usually it's 3, 4, 5% max when I buy something. Because again, I want to allow room to grow.
Right. No, that makes sense. And then, how do you determine, what's a layup for you when you see a stock that's? Do you look for prime? I guess PE ratios. Do you look? You mentioned forward earnings before. But what criteria do you look for where this is a good quality stock that's undervalued?
Yeah, look, I read an enormous amount of research. So a lot of the research is other people's research, and it's not Wall Street research. It is paid research, so that hopefully they have no skin in the game, because they're not raising money for them. They're not trying to take them public. They're just selling their own independent research, and if they don't sell you good ideas, they lose their subscribers. So I read a lot of research. So excuse me, I allow them to do the fundamental work. What I'm looking at, again, is first of all, is it a sector that I'm interested in? Number one. Number two, does the story of the research that I'm reading make sense to me? Just philosophically, do I like this idea?
Right.
And then I might look at some charts, see where it's trading relative to various things like relative strength or just its high versus its low, things like that. As I said, I'm not a certified financial analyst. I don't claim to be. But after 30 plus years in this business, you get some instincts.
Right.
And so just some basic common sense, look at the charts, read the research, if you trust the research, and if you like the story, it doesn't really matter if you buy in at 20 or 22 or 24 or 26 if you're willing to hold it for 10 years and it ultimately goes to 80.
Yes.
I mean, yeah, you missed a little of the percentage gain, but in the long run, it really doesn't matter that much.
Right.
It only matters if you're a trader, and I'm not a trader. I'm an investor.
Understood. So the criteria you look for is you want to find just strong quality stocks. In other words, they're trading are they undervalued? Will they be cheaper than the market? Or are you just looking for something that fits your theme, fits your story? Like, do you not care as much about the specific criteria, or do you look at that as well?
I'm much more interested in the story,
okay.
And the theme.
Understood.
I'm not worried about being, I'm air quoting, deep value or anything like that,
right.
Because sometimes you can get lucky. I mean, sometimes you can watch a stock that was 80 drop to 40 for no particular good reason other than they missed the analyst expectation by 2 pennies. And you realize that who cares about 2 pennies in one quarter if they're playing in the part of the investment world, the sector that you like, and it's a good quality company. That's, you can just luck into something like that. And so I've had the good fortune of doing that many times over the years, because in 30 years, you're bound to, find some things that drop like crazy over a day or two.
Right.
Other times, you're watching it for months and months and months, just waiting for a little flip off. And maybe you take a 10% knockdown, one day to say, okay, now I'm finally going to get in because it drops 10%. So it really depends.
Got it.
And again, it's really, for me, it's the story. Do I believe in the sector that they're playing in, and do I believe that they are one of the leaders of that sector? And if they are, and if I'm right about the sector, the story will bring the stock up over time.
Got it. No, that makes perfect sense. So I guess the final question I have for you, Greg, is what's the best piece of advice you'd like to share with the audience on or off Wall Street?
Well, and I'm going to repeat myself. The best piece of advice I can give is to have a plan, stick to the plan. If you're going to invest your own money, just be willing to be patient, to ride out the down times. And if you have some spare cash, maybe that's a good time to deploy your cash to buy more. Don't be greedy. Don't allow your position sizes to get too large. Don't allow any one position to get bigger than 10 or 15%, because then if that particular stock or fund drops, you're going to be in a world of pain. If you're going to hire a professional, make sure that professional, the way that professional works, aligns with the way that you want to work with the person. Some people invest in funds, some people invest in ETFs, some people in bonds, some people in stocks, some people are traders, whatever it is. There's a myriad of professionals out there using a myriad of strategies. You would need to find the professional whose strategy makes sense for you.
Right.
And that takes a little research and a little work to find that person. But if you find that person, then hopefully you'll have a long and fruitful relationship.
Got it. That makes perfect sense. Well, Greg, I want to thank you so much for coming on the show today. What is the best way for people to get in touch with you?
They can email me. Or you can go to my website, which is WAMinvest, WAMINVEST.com. That's Werlinich Asset Management Invest. And I'm just Greg at WAMinvest.
Beautiful. Well, Greg, thank you so much for coming on the show today. Hopefully we'll speak to you again soon.
Well, thank you, Adam. And to all your listeners out there, please stay safe, stay healthy, and good luck to all of you.
Thank you.